Our next session, another fireside chat, burning issue, how can investor satisfaction within mining be improved? And we have
Where do you want us?
Haytham up here for the second time, Senior VP Corporate Development for Wheaton. Bert Koth here for a second time, as you've heard from Morning Denham Capital, and moderating by Derek. Now, besides the 30-minute rule, I have one other rule. You're not allowed to repeat what you just said earlier in your talk. You got to give us some different answer than what you gave us this morning or yesterday.
Even to the same question.
Even for the same question. Over to you.
Well, I guess we'll all have to be creative then. Thank you very much, Tom. Appreciate it. And when the Mining Journal approached me and asked me to moderate this session, I was pretty excited because talking about investor satisfaction, there's a lot of people have an opinion, and there's really an easy answer to this question: how to improve investor satisfaction. Have your share price go up and make shareholders money. Now that's probably a lot easier said than done, and we've gone through. Recently, we've gone through what's been a really tough time in the mining capital markets, and we've seen that reflected in companies' ability to fund going forward. But I think everyone and all parts of the ecosystem have a part to play, whether it's the mining companies themselves and how they approach things and what they do, whether it's I work for a work broker, and there's probably a part that we play in what companies we work with and how we promote them and what we push, and on the investor side, there's also an issue is making sure that the money's going into the right places and into the right companies. I think we're going to focus a little bit more on the investor side because that's what our panelists are, but we're going to, my thought is that try to make this less of a complaining session about how we've all lost money in different ways over the last couple of years, and talk a little more about what we think can change it, what we think we can change going forward, and some of the things that we look for to make things better. And I guess I'll start with you, Bert, and we'll talk about initially. What are some of the things that you think are fundamentally challenged the industry recently?
Fundamental challenges industry-wide. Over-promotion.
Right.
Promoting something that's just not realistic, right? Saying, okay, I've got 3 drill holes and therefore it's going to be whatever, $500 million MPV, like just stuff that's just like a fantasy, right? So there's a lot of that going on. There's 2,500 something listed junior mining companies. The truth is 2,400 of those shouldn't be listed, right? so that's that's just one ad hoc observation, right? As a fund manager, I've got a lot of people coming through our doors. And frankly speaking, it's almost unbelievable how much bullshit I have to listen along the way. Secondly is that there's a bit of a herd mentality. So when the going gets tough, everybody stops development, sells the asset. When the going gets good and the price go up, everybody makes acquisitions, everybody builds projects, right? The truth is, you should buy a business and build a project in a down market and not in an up market, because that's when the capex rates are cheap, that's when the consideration are lower. So that would go a long way actually to avoid misallocation of capital. Right. If people just did that, just act a little bit more counter-cyclically. So that was just like shooting from the hip, just 2 observations, just if you ask me that spontaneously.
Sure. Haytham, yourself?
Yeah, no, I'll add a couple more things. I think some of the things that we've seen that I think most of us don't like to see is growth for growth's sake. Consolidation, just to get bigger, thinking that bigger will solve a lot of your problems. That definitely doesn't happen. And all it does is create bigger problems in the end. Right. And the other thing that's a bit of a pet peeve is you see these change of control clauses. You see, depreciation or deterioration of share prices going, probably down 70, 80%, they get bought out, and then you still have the same type of change of control clauses for some of these managements. I think what you need to see is things like that tied specifically to performance, and that's the key, right? You're rewarding the management team for exceeding expectations, not for selling out at a low and potentially taking a windfall to themselves and not to the shareholders.
Yeah, I would echo that change of control. As part of our business, we do a lot of M&A work, and that's probably one of the biggest pushbacks. Actually, realizing that when the logic is there, that the merger, the takeout makes sense. And on seeing companies, we probably see 30 or 40 companies a week. It's the same thing. and would agree with that sentiment. The second point is, and we'll start a little bit on the negative, then we'll work towards the positive. But Haytham, what are some of the red flags you see when you first meet a company that you go, okay, great, click, I'm good?
Sure, there's probably 4 things we look at when we first look at an opportunity to see if we want to invest in that opportunity. The first one is the costs. Where does it fall on the cost curve? Wheaton, the way we look at things, we're not looking to do every single deal. We're looking to do things that fall in the lowest half of the cost curve. 90% of our production comes from assets that fall in the lowest half of the cost curve. Another 8% is the third cost quartile, or 7%, sorry, third cost quartile. Only 3% falls in that fourth cost quartile. And that's because it was an asset that matured into that cost quartile. So the first thing is cost. We look at, we try to make sure it's reasonable cost. Balance sheet. We want to ensure that what we provide to companies is enough to get them to where they need to be. At least we want to be part of the overall solution, not just a temporary solution. Yeah, that's important for us. Next thing we look at is jurisdiction. Jurisdiction is very important to us. And the reason I say jurisdiction is important because we have to understand, how do we get security? If we're in certain jurisdictions that security in the asset means nothing, where the laws can be changed, et cetera. We're very cautious of that, and we have to risk adjust those accordingly. And the last one I would say is environmental. And this is when we're looking at projects that have been, whether they're small projects or large projects, we want to make sure that the company's environmental plans are in place and they are abiding by North American standards. And a lot of the times we've been to various assets, whether it's in Europe or South America, whereby you see these impending disasters about to happen because, your tailings pond is flowing into a valley or something is happening. And we try to avoid anything like that. Then we try to actually make sure if we notice it and they don't, that we point things like this out so they can improve the situation.
How about yourself, Bert?
Well, as you know, we're starting with the people first, right? So our model is really back a team where you start with the management team before they have the assets. So, I agree with everything that you say. I would rather supplement that what are for us really the red flags, the warning signs when we engage with management teams, right? One is overconfidence, right? So CEO sits here, I can't do this ramp up faster than all the industry peers. So that's a warning sign, right? And we've been through this dozens of times. Most of the time when people say they can do a better job than most others, they're actually usually doing a worse job than most others. And that's literally our experience, having lived it with our capital very, very often. So overconfidence is a real warning sign. Another real warning sign is if people are not willing to co-invest their own capital alongside with us. So it's like, okay, if it's as good as you say it's going to be, well, what prevents you from taking 20% of the money of a bank account and investing it in? If it's that great. If you're not willing to back yourself, well, why should I back you? So that's typically another real warning sign. Resistance to independent review of what's going on and the representations being made. So again, our experience Denham is a group of funds with more than 80 times incubated new businesses and at least 2,000 times in mining. So there's a certain body of experience. The more people resist independent review, the truth is the more urgently it's usually needed. So that's also a warning sign when people kind of are very protective of information. They say, don't look over my shoulder, I know what I'm doing. Don't go on my nerves. Again, our experience is the more people are protective of their own information, the more likely it is there actually is a problem that needs to be urgently dealt with. And fourth is very good technical people are super important, but being technically good alone is not good enough. There has to be some pretty good commercial and economic overlay in the C-suite. You can have the best mining engineer as your quasi-CEO type if he or she doesn't really understand the principles of capital staging, putting the first dollar to the biggest risk first, second dollar to the second biggest risk. If they have no understanding of capital allocation, there's then usually also a problem. So for example, a classical example here would be that you just like pre-order for large amounts of money, the long lead time items before you've even the feasibility study signed off, right? Well, and what then if the independent peer review of the feasibility study suggests, well, you should actually do it rather like that, and then all of a sudden you may have ordered some long lead time. Just capital staging, just principles of capital staging and capital allocation discipline. If people don't have that, notwithstanding a really good operational track record, that's usually also a warning sign. So thinking back over what we have done over the last 12, 13 years, when things didn't pan out as plans, usually in the management team you would have found at least one of these 4 characteristics that I just described. So this is what we look out now for when we engage with management teams.
It's always important because there's different parts of the business that need to be successful. Whether it's the technical side, and you need a geologist and a mining engineer. Typically, you need both to make it work, and you need some the capital allocation, how capital markets work as well to sell the story. I always find that that's one of the characteristics of success that I often see in the things that we get involved in. But maybe now that we've talked about sort of the red flags and what we see, what can be out there that's a problem. Maybe talk about some of the things, on some of the biggest wins that either Denham or Wheaton Precious Metals has had. What are some of those things those characteristics that seem to be a repeat theme? I'm guessing management's one of them, but what are some of the other things that really jump out at you as things investors should be looking for when they're putting their dollars to work and will help the industry?
Well, I mean, it's always helpful if you get in relatively cheap. That's always, this is an industry. This is an industry where negative surprises are the norm. They're not the exception. Yeah, that something takes much longer, it costs much more. That is normal. Yeah,
right.
So therefore, I mean, every single unnecessary capital outlay up front that you can avoid somehow, you should avoid, because the execution risk is a huge thing.
Right.
And it's a very risky industry. There's like 20 different things that you have to watch out for when you build a mine. So I would say, where is not what people might want to hear, but where we got in cheap, that was for sure a major contributor to success. And where we did really well was where it's just really simple projects. I mean, everything that has unnecessary layers of complexity just makes life really, really difficult. Yeah. So usually in every mining project you have one issue that you have to defeat, right? Whether it's metallurgy, or you still have to go through a time-consuming permitting process. There's usually one issue you have to defeat. When there are 2 major issues that you have to defeat, then already you need to take a step back and say, is this something investable? Yeah. When there are 3 issues that you have to defeat, because it's a difficult ground conditions and maybe more difficult metallurgy, and you have to sort out a local community that is not fully bought into the fact that there should be a mine, then it's actually really time to walk. Doesn't matter what the spreadsheet says, doesn't matter what the bankable feasibility study says. 3 layers of complexity, it's time to go. 2 layers of complexity, maybe 1 layer of complexity, we can deal with that potentially.
Yeah, that's one of the main joys of mining is complexity, because there always is there's definitely always one issue, and usually multiple.
Yep.
You have to figure out and effectively defeat. Haytham, from Wheaton's perspective.
Sure. So from our perspective, the way we manage risk is we invest in what we call management-proof assets. So when we enter into transactions with companies,
I got to talk to you afterwards.
Sure.
It's great.
we look at geological confidence. We look at the geology. We do our own internal analysis. We do a deep dive to try and determine what's there. So not only do we take the entire drill hole database and build our own block models, and typically do it in a fraction of the time that most consultants will take to do it, we'll do the same thing on the economics. So having that confidence in the actual geological deposit itself, because management change over 5 years, 10 years, they're going to change. And so you want to make sure that management can't do anything that would detrimentally affect the deposit. So we invest only in management-proof assets, is what we call it. The other thing we always do in order to make sure that our interests are aligned is we try to structure, and everybody says this, I'm sure, but win-win transactions. But the way we do it, because our model works well, because we're taking typically a precious metals, which is a byproduct of a base metal mine. And typically base metal mines trade at significant discounts to net asset values, whereas streaming companies get premiums to net asset value. We take that arbitrage that we see, and we actually split that with a partner, so that every single transaction we've done over the last 15 years, the counterparty's share price goes up, and 80-90% of the time ours goes up or stays flat as well. So it becomes a win-win transaction. And as soon as you structure one win-win transaction, the next time they need additional funding, you're the first person they're going to come back to, because all you have to do when you're looking at the next contract is find and replace the name of the asset. And suddenly you've gone from, 5 to 8 weeks of due diligence to 2 weeks or 3 weeks of due diligence. So you end up doing things fairly quickly.
Yeah. Management-proof assets. It's funny.
I love that story, by the way.
Yeah. I always say that my line is a bad management team can screw up a good asset, and a good management team can fix a bad asset, and that's the difference. But there are some assets out there, and there are exceptions. So which is, we were having the conversation earlier. Maybe talk a little bit about the number of projects you guys are reviewing and versus the number of deals that you're actually doing.
Sure, and it's quite a telling story. So we look at probably 70 to 80 different opportunities in a given year, and probably 40 or 50 of those are small opportunities, and the other 30 are, probably medium, and maybe about, a handful of those are large opportunities, and they'll take time to come to fruition. I can tell you, if we're happy if we enter into 1 or 2 transactions a year. We're not, and the issue is when we do our deep dives on all these, the technical reports, the feasibility studies that we're seeing are nowhere up to par where they need to be at this point in time. We're seeing so much weakness in costing, in overall, looking at the overall economics, in mine scheduling, mine design, mine planning, that we're having to reschedule the entire thing to get comfort with what we see. And then if we can't get the other side aligned on what we think they should be doing, then there's no point in us investing our money in there.
It's an interesting point on the technical studies. I think that you talked earlier about the negative surprise factor and what happens, and I think that's the nature of it. Technical studies are often done for the market, not for people who actually build mines. And
Exactly.
And you get that. That's why you have that negative surprise factor. What about yourself at Denham? What kind of rate are you guys as far as review versus actual investment?
I hope when I give the statistics, there are still people sitting here afterwards. No. So we business planned with more than 400 management teams. We ended up backing 8 with capital. Together with those 8 management teams, we screened well in excess of 1,200 projects and invested in 13. And if in a given year we do not do a single deal, that's also fine. That's perfectly fine. There's no rush to deploy any capital. It makes all the sense in the world to hold out for the genuinely best opportunities. Even if in 1.5, 2 years we don't do a new deal, that's also fine. And there's absolutely no rush, because the thing is, if you get one wrong, the time and the energy it takes to rectify a problem in your portfolio, when we rather hold time and money back for the real convictions calls together with our management teams, because we transact through the management teams who are back on a private basis, where we say, that's the one, we really gotta have that one. As soon as the due diligence throws up really a lot of questions, and it starts to look like a little bit already middle of the road, you know what, just let it go. There's always another day and another opportunity.
It's interesting what you said there. If you look at sort of traditional institutional investors, it's not their investments that are going well that cost them time and headaches and challenges. It's the as we like to call it, the problem children that create the issues and end up being the hardest ones to deal with. I guess one last thing, and this is interesting because you both are active investors per se, as opposed to passive. What are some, when you're structuring companies or you're structuring deals, what are some of the management controls that you guys like to put in place? Because those are the things that are probably good governance practices that should be in all public companies that we don't necessarily see. I'll start with you, Bert, on that.
Well, I mean, again, as a private equity control investor, we see ourselves as partners with our management team. So as a starter, we work like on a weekly basis, hand in hand with our management teams. So literally, someone from within our fund on various levels speaks typically every day with a member of a management team, and thus also with the company. We are real time live on everything. If the ramp up phase, the production statistics and ramp up statistics feed every 3 hours through to my iPhone. Right. So I know exactly every day what the feed grade was of the zinc or whatever for underground mines in Queensland. We have an information infrastructure that makes it very, very transparent to us at all times what happens. We have a weekly scheduled update call with every single one of our management teams where we go through all the metrics. So it's a world of genuine accountability.
Right.
So there is a kind of, and every deviation on a weekly basis has to be explained. And there are typically board meetings as well, but unlike in a listed company where you have a fixed schedule of quarterly board meetings, we do the board meetings when they're genuinely needed. Yeah. Right. So whenever important decisions need to be taken. So if it needs to be, we can arrange board meetings within 48 hours. So.
And you mentioned those weekly update calls. What are some of the KPIs that you guys look for, whether it's a development stage or a production stage company? Production stage is obvious. What are some of the development stage companies?
In the development stage, it is really, you have the key milestones that you need to get to steady state production and by when they need to be met. And like we know every single day whether we're on track of those or not, like every day.
Yeah.
So this is not like that you wake up 3 months later and, oh gosh, we're 4 months behind. It's like we know it on a daily basis where we stand in every single one of our assets on the journey to steady state cash flow. And the good thing about private equity is because we have no share price to worry about, right? I mean, as adults in the room, we understand that in real life, frankly speaking, a majority of projects are going to be some negative deviations. That's going to cost more or going to take longer. And when that happens, we just sit down with our management teams and we figure out how we're going to go from there. So there's no share price that tanks or anything like that. We just sit together as partners and we figure it out.
I think that's a good point for sort of everyday investors who are looking at that accountability on timelines, and then following up with management as to where they are in their timeline. And then there are going to be negative deviations. Yep. It's the nature of
they usually are.
They usually are, but it's also do they have a plan to get it back on track, and how are they dealing with it, and what's the real cost of where it is?
And the good news about this kind of permanently knowing what's going on is that you can actually catch negative deviations in time before they actually mothball into a bigger problem.
Right.
So if there's, for example, if for whatever reason, again, there is an issue because whatever, in the blasting, whatever, the cave doesn't properly come, whatever it is, right? Yeah. You know about it early on, and it allows you much faster to take corrective action together with the management team.
Yeah. So we differ a little bit because we're not typically equity investors. We don't have that liquidity. We invest in projects, we invest as partners, and we're effectively silent partners. So the way we cover ourselves is, one, we do our due diligence up front, make sure we're only investing in the highest quality assets. And I've said this several times. I know you didn't want me to repeat it, but that is quite important. Two, we look for things like monthly reports. We look for corporate development updates on how the projects are going, expansion updates. We do site visits twice a year, at least once a year, sometimes 2 or 3 times a year if we need to get out there. We actually have a program we call a technical ambassador program, because everybody within the organization that works for my team is technically sound. I'm a mining engineer. I've got a bunch of mining engineers, geologists, and process engineers, and geological engineers working for me. We actually have a technical ambassador program where when we go to their sites, we actually look for ways to help them improve their projects. And because it streams, we're taking a percentage of the production. When they do better, we do better.
Right.
So we do everything we can to provide. That's, we're not doing that. We're not charging for something like that. That's our duty, and we believe that that's what our responsibility as a good partner to try and help them get to the next stage. And for many of our operations, we have seen improvements in efficiencies, which have resulted in higher production. And so our partners are very thankful for that. So.
That's great. Probably after this panel, I got to go look up Denham Capital and Wheaton's holdings and put some money to work based on the level of due diligence. We've got about 5 minutes left, but I actually want to. This is a really interesting topic, and so I really do want to open it up to the crowd for the audience for some questions. I didn't check this beforehand, but I presume that there's a mic and a runner. We'll start there, and then we'll come on.
Thanks, enjoyed that. What are some opportunities that you've both passed on and looked back on and wish you hadn't passed on?
I'll answer that by saying I'd rather not answer that. There are opportunities, and they've, on the streaming side, there are quite obvious ones out there that have been disasters. I can tell you, just because we weren't the successful bidder, there's a reason. Sometimes you don't want to be the successful bidder. Often we put in bids to make our competitors pay more. And that's a very viable strategy. You put in just a bid high enough that you know they're going to pay more for it, but you don't want to win it. And if you win it, you're probably comfortable with the IRR that you're getting on that transaction. So, there's been some disasters on the streaming side, and we've looked at everything, and we've passed on quite a few.
All right, up here.
You've both looked at a lot of projects that for whatever reason, whether it's geography that you're not comfortable with or scale of the project, which it doesn't fit your criteria. For those projects that otherwise don't fit your criteria but otherwise are interesting from an economic standpoint, how do you recommend, or how would you, from your standpoint, recommend the management teams advance these projects as far as financing is concerned?
Well, most of the time when we decline it, it's because we think there's just a flaw somewhere. With the management, we think there's a flaw somewhere that will come to haunt us once we build it for real, right? So it's less country because, we back teams in specific countries. So, because we want to be there. So typically when we decline, it's because there's a kind of a pretty legitimate asset reason for it. And when we decline a management team, it's because we believe there is a people reason for it. Yeah. Okay, but let's talk about those projects who we decline for reasons that are ulterior and the project is viable. In those cases, we sometimes help people, we steer people to other sources of capital that for who the project might fit. We're a very collaborative group of people, right? So when we really believe a project makes sense and it's just really too small for us and doesn't move the needle, well, we give them 2 or 3 addresses of other people where they might go to, where it might work. But experience so far is most of the stuff that we turn down is because we really didn't believe it's going to work, or we really don't believe that the people are going to succeed.
Just to answer the same question, so obviously there's different tiers of streaming and royalty companies, et cetera. There's different, and when I say tiers, there's different requirements that they look for in certain transactions. So often when a transaction, for example, is high cost, but they're looking at doing a stream or a royalty, we won't get in there because it doesn't meet our margin. But that doesn't mean some of the smaller guys, which actually look for the leverage. So it's just a different strategy that they employ. They look for leverage and movements in commodity price to drive their earnings higher to improve those projects. Our strategy is a little different, but those are the kind of companies we'd actually point you to. And it's a small industry. If there's something that doesn't work for me that works for one of my competitors, I'm happy to let them have something that, it supports the entire mining industry is what we're looking to do. I don't want to win every deal. If I wanted to win every deal, I'd have 30 deals already this year. I'd pay up for them, and that would be that. But that's not our strategy. Our strategy is to provide our shareholders with a safe, organically growing company and having a corporate development team and a management team that's able to structure accretive transactions. That's effectively what our philosophy is going forward. But there are many companies that will look at that. And if you're having problems, please approach us. We're happy to give you some names.
We'll take one more quick question, and then I think our time will be up.
I'd like to ask you, you have a project that comes to you which it ticks all the boxes apart from the management. Have you had situations where you've actually asked you've actually implemented a change in the management? It might be the CEO, it might be the COO, it's something at that level which otherwise you would actually invest in.
Well, we typically start with management before they have the assets, so typically the situation doesn't present itself, right? So when we buy projects, we buy them through the management teams who we already back before the asset exists. So the situation that you described typically does not present itself in our investment strategy. Okay, but then let's say we have a situation where we made the wrong call on management, yeah, and that has also happened. Fortunately, not very often, but it has happened, yeah. And in that case, we do need to take corrective action to protect our money and to protect management's personal co-investment as well, frankly speaking.
Okay, we're out of time. Thank you very much, gentlemen.
Thank you.